Welcome to the InterMarket Analysis update. This is a video that I do once a week, and we look at a number of different areas. We look at the current, forward, and historical valuation of the S&P 500. We also do a pretty intense look between growth versus value. Growth is when you want to buy low and sell high. Value is when the market's becoming more defensive. And then we look outside of the S&P and compare other sectors, other indexes to the S&P, because sometimes I can give us some insight as to what's happening inside of the S&P 500 itself. This is being prepared for Monday, August 5th. I do have a thing called the SPXInvesting Program. It launched in the beginning of June. It's still free. It's still wide open for right now. I'm probably going to lock that down in August, but feel free to check that out if that is of interest to you. If you want a link to get you to the website, there's a link in the description below this video. There's also a link to take you to some other videos that talk about the program itself. And here's an email address if you have any questions or you want to contact me. The video that you're watching right now is just one of various videos that I do each week. The real foundation and the real focus of my analysis is in the video that I do each day. The other videos that I do once a week, they're meant to augment the daily video update. So if you're only watching this, you're missing out on a lot of the analysis that I do. Feel free to check out some of the other videos that I also post. Let's go in and look at S&P 500 valuation. First, we look back using historical data. This is the trailing 12 months going all the way back to 1980. Even though we've been coming down with the S&P and it's been under pressure, we're still well above this red dashed line. The red dashed line is a PE ratio of 20. Excuse me. And when we're above that, that means on a historical basis, and when we compare earnings to price, we are overvalued right now. But we've been overvalued for many years, and we can stay overvalued for a long time. So we don't necessarily use this to make decisions. We just use this for informational purposes because the market can be overextended. And if we tried to time things based on this, look at the huge upward move that we would have not been able to partake in. Then blown up down below is just the difference between where the S&P is and the red dashed line. When we're above zero, that also means that we're expensive on a historical basis. Then here is that same chart for some reason. Then we look at this in conjunction with other events that have happened going back to 1980, and just to see what the valuations were at that time. And we do spend a considerable amount of time being expensive on a historical looking basis. And that's pretty typical for the stock market. It likes to think good things are going to happen, that earnings are going to go up in the future, and it justifies the higher prices right now. There's another approach to this developed by Robert Shiller that takes more of a smooth approach. And this is called the Shiller PE ratio. And for some reason, I have May 1892 marked here. I'm sure all of you were wondering what the value was at that time. But right now we're coming in with a score of 34.48. Well, to give us some context, the median and the mean is anywhere between 16 and 17. So we're still over double. Even when we smooth this out using the Shiller method, the market is still considered to be expensive on a historical basis. But, and this is taken from Edward Yardeni's website, the market doesn't look backwards. It looks forward. And so we have forward PE ratios. And we're even with the pullback that we've been seeing, we're still looking a little frothy right now. The purple line, this is the Magnificent 8 or Magnificent 7, whatever it's called, the Mega Cap 8, whatever. It's coming in at 29.9 right now. It has dropped down as they've been under pressure, but still, when you compare it to that 10, 15, 20 scale, the mega caps are considered to be expensive, but they've been expensive for a while now, and they'll probably still continue to be expensive. Again, we don't use this so much for making decisions. This is more just for information. Now, the red line is the S&P 500, and even looking forward, we're still considered to be expensive here because we're above 20. And we've been seeing a bit of a bounce here. When we look at the mid caps, we're right around the 15 level, which is that fair value level, and small caps, which gave back some of their gains They dropped back under 15. They're coming in at 14.6. So when you look at small caps and mid caps, they're more fairly priced, but is it necessarily a good time to buy those? On a valuation basis, maybe, but on a technical analysis basis, maybe not. We'll go through some of the charts and see how these things look. Then we look at growth versus value. This is just a pure growth index. It is in an uptrend, but it came all the way down to its 200-day moving average, especially in Friday's session, as the market has been under a lot of pressure. We look at value, which also is in an uptrend, but did see some weakness. Everything got taken out and shot in Thursday and Friday's session. So we're seeing a lot of weakness later in this past week. Then we look at ratios between the two. This is growth to value, where growth had been outperforming. Now it's starting to pull back. On the bottom is an inverse showing how value has been underperforming, but starting to bounce up here. And then we look at some indexes, a longer-term chart, looking at growth to value, where growth is still in an uptrend compared to value, but it has been really pulling back. This is an inverse, how value has been underperforming, but showing some recent strength. Then we look at the value to growth here, another way showing how value has been underperforming, but lately been bouncing back up. And here's growth to value again. Number of different indexes, different ETFs, different ways of measuring this, long-term charts, shorter-term charts. We want to get a lot of different perspectives on this. And this is also showing how growth is outperforming, but has been pulling back. Here's a longer-term look at the ETFs, where growth has been doing quite well, but recently under some weakness here. Here's some ETFs. Now, this is one thing that I've been watching in the daily videos, and we want to keep an eye on this. This is a growth ETF compared to a value ETF. And we've been weak here, but we've come down to this 250 period moving average. And so far, this level has held. This happened back in April, where we came down to this same level before. The market was able to bounce up off of that and really get some strength. Are we going to see something like that this time? Are we going to see a bounce up off of the 250 period moving average, or are we going to start to break down below this rainbow and look even more negative? Here's just an inverse of that same thing, with the value showing how it's coming back up really close to this 250 period moving average, but it hasn't quite broken out above it, at least yet. Then we break it down and look at small cap growth to value. Not doing all that well, even though it bounced up a bit here. It had been in an uptrend, but then we've been declining lately, and we're starting to see a death cross with this ratio. Mid-cap growth to value, not doing very well right now. S&P growth to value, not doing very well. We keep an eye on inflation, which has been coming down. This is a monthly chart of the CRB, which is declining. We're also declining with the ratio between inflation and deflation. Then we look at the CRB. This is a daily chart where it's still in an uptrend, but it's really been pulling back lately. And we look at the Baltic Dry Index, also in an uptrend, but it's also been falling back. This is another inflation gauge that we look at. When this is going up, that tends to be more inflationary. When this is going down, that's more deflationary. Then we keep an eye on some other markets. Even though I personally am not involved in these markets, it's still nice to look at them at least once a week. Here's aluminum, which is in an uptrend, but really been falling back. Here is corn, which continues to be in a downtrend. Wheat is also in a downtrend. Fertilizer going up a little bit recently, but not any real big price swings as of late. Oil has been dropping down into the lower 70s. We want to keep an eye on oil. There is the potential of things escalating in the Middle East, and sometimes oil will go up in reaction to that. As of Friday, the markets have pretty much been ignoring what's going on. They're more worried about what's going on in the US with inflation and the weaker than expected economic data. But if oil really starts to go up because things are getting more tense in the Middle East, that is more reactionary, and that could actually have a negative impact on stocks. Now, there are other times when oil can go up because the companies are making more money and everything's looking better, and then oil can go up with the stock market. So we want to watch for the context of what is oil doing if the markets end up starting to pay attention to it again. Keeping an eye on gas, which is still in a downtrend. Heating oil is also in a downtrend. Natural gas is in a downtrend. We have diesel here, which is, I don't have any moving averages. This is an Edward Gardeni chart, but you can clearly see where it's been declining. And copper, this has been weakening lately as there's potentially some economic weakness coming in. We saw some weak data on Thursday, and the big one was on Friday with the employment situation report. And now, instead of bad news being good news, and maybe the Fed will cut rates because they want to stimulate the economy, the market, at least as of Friday, is fixated on bad news is bad news, and that could mean economic slowdown, possibly recession. We don't know how things are going to play out. The market is very fickle in how it looks at these things. But one of the reasons that the market's getting a little more fearful, we can see that in the price of copper. When it's going up, that looks better economically going forward. It's still in an uptrend, but oh boy, has it really pulled back all the way down to its 200-day moving average. Will it be able to bounce up off of that and start to go up, or are we going to actually break below the 200-day moving average? We look at another ratio of copper, which is more measuring the economy, and gold, which is more inflationary and fear and insanity. Well, copper had been outperforming enough to generate an uptrend with this ratio, but it's really been underperforming, and we're starting to see a death cross here as gold has been outperforming copper. This is a longer term look at that same chart. This really going down. That means copper has been underperforming. Just to give it some context, we're seeing a real drop in the 2-year and the 10-year here, just to give us an idea what's happening with interest rates. Gold really hasn't broken out. You wouldn't know that by listening to the people that really love gold. And this is just the gold ETF. This is not the futures contract, but it's still been holding up and is still in an uptrend as well. Silver below its 50-day moving average, but still in a longer term uptrend. We look at the closing price for gold on top and the closing price for silver in the middle. The correlation is not as strong as necessarily you would think. You would think silver and gold, they go in tandem with each other. And a lot of the time they do. That's when this reading is really high across the bottom. But sometimes they get a bit out of whack with each other as well. Then we look at a gold to silver ratio on top, and we plot the US dollar index in the middle area. And we're seeing that there's not a strong correlation between the top chart and the middle chart. So this really is not helping us currently. We are seeing some weakness in the dollar, but it's still in an uptrend. It's getting close to seeing a death cross on the weekly chart. Here, we have a ways to go before the moving averages actually cross over to give us a death cross there. And this is just a look over the last 3 years. We started to break out. Now we're coming back down. If we continue to fall, I'll probably extend this trend line down. Keep an eye on the euro, which has really been chopping sideways. And here's the US dollar index. And then we also plot the Japanese yen, which is really bouncing up, but it's still in a really solid downtrend compared to the dollar. So we look at the euro to the dollar, and it's just barely, the blue line is just barely below the red line. It really spiked up, so this could be getting ready to be in an uptrend against the dollar, but it hasn't quite happened yet. Here's the Japanese yen in a solid downtrend, but then as the Japanese government has been coming in to try to prop up the yen and messing with interest rates and so forth in Japan, that's really been giving some support to the Japanese to US dollar relationship, but it still has a long ways to go to repair things. The British pound falling back, but still in an uptrend compared to the dollar. Looking at some index ratios. As we've been under pressure lately, the broader market or the rest of the S&P 500, other than the Magnificent Seven stocks, they're actually holding up a bit better. Now they're getting hit, but they're not getting hit as hard as the Magnificent Seven stocks have been. And when we look at the broad market itself, it's actually been holding up better than some of the large caps and mega caps have been lately. When the red line is above the bar chart here, that just means they're both going down, but it just means that the equal weight S&P is holding up a bit better, even though they're on different scales. Then we look at another way of measuring this. This is the equal weight to S&P ratio. When this is going down, that means the equal weight is underperforming. Lately, it's starting to go back up, showing that the equal weight is starting to outperform. Okay, then we look at stocks versus commodities, and even with the weakness we've seen in stocks, we've seen more weakness in commodities, so this ratio continues to go up. Here's an inverse showing how this ratio continues to go down. We look at the NASDAQ 100, which has been under pressure and not looking really solid right now, and compare it with the S&P, which is also under pressure right now, but it's holding up better. It has more stocks. There are 503 stocks in the S&P. There's more diversification there. And so when we're under pressure, where the NASDAQ 100 tends to go down faster than the S&P, and the S&P tends to hold up a bit better. Well, we're still in an uptrend when we compare the NASDAQ 100 to the S&P, but it's really been falling back lately. We look at the S&P 100, which are the biggest stocks in the S&P 500, still well, they were in an uptrend. Now we're starting to see a death cross here as the big stocks are underperforming the rest of the S&P 500. The NASDAQ to S&P 500 ratio, both have been under pressure lately. Falling back here as the NASDAQ has been underperforming as of late. We look at the NASDAQ 100, which is underperforming the NASDAQ itself. And we saw a death cross here going back to April or May. That would be May. And we haven't really seen much of a recovery since then. Then we look at the mega caps, the stocks that everybody seems to love until they don't love them anymore, and compare it with the equal weight S&P. This has really been declining, but it's still showing that the mega caps are in an uptrend overall. Small caps, it looked like, okay, here we go. We're breaking out. Well, they broke down this past week, and they were down pretty heavy for the week. Small caps continue to underperform the S&P, even though they were bouncing back up. Now we're starting to see some weakness. Are we going to see a return of the love to small caps, or are they going to fake us out like they did in January and a number of times throughout 2024? It looked like they were breaking out only to go back down. Biggest software companies, not really doing all that great, but not really doing all that bad. They're below their 50-day moving average, but they're still in an uptrend. The mega caps pulling back, dropping below their 50-day moving average, but still in an uptrend. The robotics and AI ETF, this is another one to keep an eye on, coming down to this 250 period moving average inside of this rainbow. Are we going to be able to bounce up off of that, or are we going to fall down below it? And also continuing to underperform the robotics and AI ETF when compared to the tech sector, as both have really been under pressure lately. And here's the Dow Jones Composite, which takes the Dow, the transports, and the utilities. And all the strength right now is coming from the utilities. So we're still in an uptrend, even though it has been pulling back lately. And then we look at some different ratios between stocks and bonds. This is the S&P to 1 to 3 year bonds. We're coming down as we're seeing some weakness as stocks are underperforming shorter term bonds. Then we look at the S&P 1500 and also compare that with shorter term bonds, starting to come back down into the rainbow. Another broad market measure going a little further out. We're seeing this coming back into the rainbow as stocks are underperforming. And this was another area of hope, and I was pointing this out in the daily videos. Even though we were declining, we were staying above the 50-period moving average here with the total U.S. stock ETF. Well, we broke below that on Friday. So are we going to come all the way down to the 200? Are we going to be able to bounce and get back above the 50? Just something that we're keeping an eye on. The low volatility stocks, these are really going up, and this is what folks get into when they turn more defensive on the market. But when you compare it to the S&P, still really underperforming, even though it's been making a strong comeback as of late. We look at the tech sector and compare it with bonds, coming all the way down to the 250-period moving average. Are we going to be able to bounce up off of that, or are things going to turn more negative? And then we look at the advanced decline line studies. This is actually encouraging, at least as of Friday's close. We're going down across the board, but we're still above the moving averages here on all the indexes. And you can see down at the bottom, when we look at Dow theory, here's the Dow, the transports and utilities. Utilities just screaming up. Now, is that a defensive play? Or is that because everybody likes utilities and interest rates are going down and their earnings are going to be better and there's going to be more demand because of all this AI stuff happening and mining that's happening for cryptos and the increased need for electricity? Is that what's causing this to go up? Or as we saw right at the end of 2021, we saw utilities really going up here. This doesn't go back far enough, but that was a defensive posture before the market was getting ready to go down. We're just watching to see how this ends up playing out. And we look at the transports, which had been showing some improvement when compared to the S&P, but still really underperforming. And just kind of just in that same range that it's been in 2024. We look at the correlation getting a little bit stronger as the S&P has been going down. Naturally, the transports have been going down. So their correlated relationship is actually getting a bit stronger right now. And we look at a new take on Dow theory, where instead of using the Dow, we use the S&P. And instead of using the transports, we use the NASDAQ, and they're both in pretty severe declines currently, but possibly at a point of finding support. We're right at the 100 period moving average with the S&P. Here's another look at Dow theory. Instead of using the S&P, use the S&P equal weight. And instead of using the NASDAQ, use the equal weight QQQs, which is the NASDAQ 100. We're seeing more of a pullback now with the Qs. And we are declining here with the equal weight, but it's still above this previous breakout line that I have on here. And the FANG index, this is something we were watching throughout the week. We could not get back up and close above the 50-day moving average with the FANG index. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia's in there, I'm sure. Well, we finally broke down and we're further below the 50-day moving average right now. So that's turning more negative, even though it's still in a longer-term uptrend. And I drew some lines on here. I'm not a, well, I do use trend lines. I prefer flat lines. I think they're more powerful because you could draw all kinds of crazy trend lines any way you want to. But we are starting to break below some support levels here. If we continue to fall, I'll try to draw in some horizontal lines that I think are more powerful. You've probably heard me say this before. If you draw enough lines on a chart, you can get it to say whatever you want it to say. So I try to remove as much emotion from this whole equation as possible and not say, oh, I think this is going to happen. Oh, look at that. I'm interpreting it that way. I try to use charts that are just positive, negative, and there's very little ambiguity between them. This is not one of those charts. Then we look at a ratio between the Dow and the transports. We've been chopping sideways lately as both the Dow and the transports have been under pressure. The Wilshire, this was also another area that was giving us some hope. We were just camped out above the 50-day moving average, and it looked like maybe this is providing some kind of good support level to go up from. And this is another broad market measure that we look at. Well, in Friday's session, we broke below that. So this is turning more negative. ARC, of course, it had to be down. It was down like 10% on the week, and it continues to be in a downtrend and is really struggling. And then the all world stocks, when you take out the US, also pulling back right now. And even though the S&P and the world stocks are under pressure, we still have the S&P outperforming, but it's just coming back down to its 50-day moving average. This is a monthly chart of the S&P, and then we look at stocks in Europe, Australia, Asia, and the Far East, still hanging in there, but this is a very long-term chart. And also the momentum continues to be positive. And we look at bonds just screaming up here now with the total bond ETF. This is bonds based on price, and they are really catching some fire right now. We are catching some fire with the World Bond Index, but not enough to turn the trend back positive. And bonds are turning up when compared to stocks, but they just continue to underperform overall. Are we going to start to see a switch? Monthly chart of the stock to bond ratio coming down just about to the moving average now. Is this going to show some weakness, or are we going to be able to bounce up off of that? Corporate bonds right here, also seeing some real improvement here. I'm sorry, these are high yield corporate bonds. These are junk bonds, and they're continuing to do quite well. And this is the corporate bonds. They're also going up, but still have a long ways to go to get back to their all-time high. We look at the stock to bond correlation. They're having a slight tendency to go in opposite directions right now. As bonds have been going up based on price and stocks have been going down based on price, that's why we're seeing this relationship show weakness. This is something interesting too. We watch this all the time. Riskier bonds like junk bonds and more conservative bonds like government bonds. Folks were willing to take on more risk to get a better yield. Well, if interest rates have really topped out and they're going to start coming down, folks are going to get out of the junk bonds and get into the more conservative bonds and then just ride them out for 7 to 10 years or 15, 20, 30 years because they think that interest rates are as high as they're going to go right now. They're only going to come down, so they want to lock in that yield for longer. And that's when we see this ratio starting to come down. And we're actually dropping below the rainbow currently. So are we starting to see a shift? This chart says yes, but we have to also look at other things to confirm this. Corporate bonds going up in price right now and coming down, but not really near any fib extension or fib retracement levels here with the 10-year yield coming down with interest rates, but still in a higher overall environment than what we've seen over the last 40 to 50 years. Also coming down with the 30-year yield, but not near these retracement levels yet. And even though this is going up, it's not because the S&P is going up, it's because the 10-year yield is going down. And so that's why this ratio is actually showing some strength on this chart. Is also starting to go back up here when we look at 3 to 7 year bonds compared to stocks as well. To be more positive, we want this ratio to go down, and now it's starting to go back up, but longer term, it is in a downtrend. We look at the price of 7 to 10 year bonds, really starting to go up right now. The junk bond, risky bonds to government bonds ratio starting to drop off as folks are ditching some of the junk bonds right now and getting into more of the conservative bonds. Is this part of the shift? And junk bonds themselves, they're doing okay. They were down, but they're still above their 50-day moving average. And then we're just seeing a real drop off here across the board. This is a daily chart of all the different yields, and it's just going lower right now. And we look at the volatility of bonds on the top, that's the move index, the volatility of stocks, which is just screeching up here. Both are really showing some volatility right now. And so the correlation on the bottom is pretty strong. This is not price, this is volatility, a comparison between the two. And both stocks and bonds are quite volatile right now. And this is the weekly chart here, how they've been dropping not only in the US, but internationally, in the UK, in Germany, and also in Japan. And then this is a long-term look at the 30-year price of the 30-year bond. It's finally broken above the long-term downward sloping moving average. Not enough to really change the ratio down below, but this is showing something that we haven't seen in a long time, going back to 2020. All right, and then the different sectors. This is something that I found during the week. I think it was posted on Twitter or something like that, or X, whatever you want to call it. And these are the 11 sectors of the S&P, and the bigger the bubble, the bigger that sector influences the S&P 500. So we have tech right here. It's pretty big. And then we have discretionary, which is also big. Amazon's a big part of that. Microsoft, of course, is a big part of the tech, as is NVIDIA. And then it just shows, here's Google and communication. So just the different sectors and then some of the big areas inside of those particular sectors, just to give you a little visual representation of what's going on. All right, so then we look at the materials sector all by itself, coming back, and it was able to get back above its 50-day moving average. And it's in an uptrend, and both when we look at the relative strength and the momentum is going down, but both of them are still above zero, where the relative strength is showing some improvement. Then we do a comparison of a ratio between materials and the S&P, still in a downtrend, but it's been bouncing back up. Here's communication, one of the stronger areas, came all the way down to its 50-day moving average. Is this going to hold, or are we going to end up dropping below that? And it's been really choppy lately when we compare it to the S&P. It's kind of up and looks like a weird EKG right here, but it's been holding up better as of late. I'm looking at energy. Came all the way down, just hit its 200-day moving average. Isn't that interesting? And was able to close up off of that. We are showing some weakness, but we're still positive when we look at relative strength and momentum. And we're still underperforming when we do a ratio between energy and the S&P. Financials really doing well. Came down to their 50-day moving average. We're able to bounce up off of that. And just kind of all over the place now. Still in a downtrend with this ratio, but really showing some improvement as of late. And then the industrials dropped a little bit below their 50-day moving average. And when we compare them, they came all the way up to the 200-day moving average with this ratio, and now they're starting to pull back, and we're still underperforming longer term. Tech sector, the darling, it broke below its 50-day moving average and possibly headed towards its 200-day moving average, seeing a real drop-off with relative strength, a little bit of an improvement here with momentum. That's the green line. But really underperforming as of late, even though this ratio is still in an uptrend. This is what we've been really focusing on lately, the small caps to tech sector. When this is going down, that means the tech sector is outperforming, and that's what's been happening. But then all of a sudden, everybody caught love for the small caps, and we saw this really starting to go back up. Well, they got hammered in Thursday and Friday session, mainly Friday. And so this ratio is now starting to come down, and it's still in a longer-term downtrend. And then staples, these are the things that folks get into. This is a defensive area when they're worried about the market going down, and this is still looking solid all by itself. Still underperforming longer term, but showing a lot of improvement on the ratio with the S&P. Real estate starting to look a little bit better with the potential of interest rates actually going down. Still underperforming, but improving when we look at the ratio between real estate and the S&P. Utilities just screaming right now in a very solid uptrend. The relative strength and the momentum are really solid. And they've been really choppy lately here, where we started to see an uptrend, then a drop below. Now we drop below and it's starting to go above. So we could be getting back to seeing an uptrend with this ratio. And we've been watching this too, the S&P to utilities ratio. When this is going up, the S&P is outperforming. When this is going down, which is what's happening now, utilities are outperforming. And healthcare, another defensive area, because you have to have healthcare no matter what's going on with the economy. And it is still in a downtrend, but really starting to bounce back. This is another defensive area. Discretionary coming down and dealing with its 200-day moving average on its sector basis here, and still underperforming on a ratio with the S&P. And we look at growth stocks and compare them with bonds, really showing some weakness here. Even though this trend and this ratio is really solidly up, we came all the way down and we're actually dropping below the 200-day moving average with this ratio. Semiconductors, another darling area. Well, not so darling right now. They're actually dropping below their 200-day moving average. And we look at another ratio between energy and tech, where when this is going up, that means energy is outperforming, but longer term, energy is still continuing to underperform. And we look at the tech sector and compare it with the 10-year yield. And again, the reason why this is going up is not because tech's going up, it's because the 10-year yield is going down. And we're seeing that same thing here with this ratio going down because we're seeing a decline in interest rates. Discretionary to staples, not really holding up. This is discretionary to things that make life fun compared with staples, the things you have to have. When this is going down, that means discretionary is underperforming and the staples are outperforming discretionary. Gold is not really outperforming, or it's just kind of chopping around right now when compared to the S&P. And we look at all stocks, which dropped below the moving average here and are seeing some weakness, but still in a longer term uptrend. And then we look at gold to the dollar, where it's been holding up better as of late. And the NYSE composite coming down to its 50-day moving average, but still hanging in there for the time being and still in an uptrend. High leverage loans, just a little bit above their 50-day moving average. If, again, as I always say, if the economy was getting ready to fall apart, we would not see strength with this ETF. This is a very risky ETF. There are very smart people that get into this ETF that really pay attention to what's going on. We're not seeing this falling apart. So there's really not an awful lot of weakness coming into this part yet. Emerging markets, pulling back, but still in an uptrend. And Japanese Nikkei, somebody posted, this is the biggest drop in, I don't know what, since Pearl Harbor or something with the Nikkei index. All right, and the micro caps still in an uptrend, but pulling back. And the S&P and home builders, we're not really seeing any real divergences right now. And then Bitcoin, it broke below 60. And of course, all the anti-Bitcoin people are out there. Yeah, look at it go, man. It's going to zero. Well, it's got back up. It's right around the 60 level. And it's in an uptrend, but we're in danger of seeing a death cross here with this trend. And we're seeing some weakness in China. We're going down with the KST, going down in the emerging markets, down in Europe, rolling over in Japan, and rolling over in the US. And this is interesting too. The InterMarket Analysis chart going back to the beginning of the year. We now have gold in the lead, even though it's declining, and then stocks, and then oil, which has really fallen back. And we have the dollar, which has also been down. And for the first time in 2024, bonds based on price have actually gone positive. Then we look at some correlations between the S&P and the dollar. Kind of really neutral right now. They're not really keying off of each other, as both have been going down as of late. And S&P to oil, fairly strong correlated relationship, but both have been going down. We see the S&P going down and oil's going down. We want to keep an eye on the price of oil to see if if it reacts to geopolitical events. And we look at the 10-year yield and compare it with the S&P, having a tendency to go in the same direction, down right now. And also the 10-year to tech, same direction, down at the present time. And then to the 2-year yield, also down. Look at how this is really dropping off. Wow. Okay, then our long-term look here. This is a monthly chart of the NYSE. Even though we're pulling back, longer term, we're still above the moving average. And the Copic curve, which is a momentum oscillator, continues to go up. So the long-term trend, and if you watch the weekly video, the long-term trends are still up there too. Even if you look at the daily charts, the long-term trend is still positive. We're just going through what right now looks to be either a decline, possibly all the way down to a correction. That's between the 5 and 10% fall for right now. Now the perm bears are going to come out and just end of the stock market, 50%, 70% decline. Fine, let them say whatever they're going to say. We're just going to follow the charts and see at some point are buyers going to be interested to come back in and do some buying. And here's a daily chart of the NYSE. This is still going up with the record high percent index. And then here is another monthly chart of the S&P rolling over, but still above the moving average. We are starting to roll over a bit here with the PPO. This is a momentum oscillator, and this is a bit of a concern to us. And then we look at the S&P on top, and then we look at a ratio of stocks to commodities, still showing on a longer term basis how stocks are outperforming. And this is another look at the S&P on a monthly chart with global stocks. The S&P is still holding up better. The KST is still continuing to be flat. Then at the very end, I go through a list of all those things that are positive. For this video, the definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. And our list is still very long. Growth and value by itself, even copper, has been showing some weakness, but the trend is still up. The British pound to the US dollar, gold, silver, the dollar, CRB index, the big software companies, the mega caps, FANG index, low volatility ETF staples, the Dow Jones Composite Average, all of the bonds based on price except for world bonds, even though they are bouncing back up. The tech sector and semis for right now, but they are under some real strain as of late. High leverage loans still looking really solid with that chart. The Dow, the NYSE, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100 are still in longer-term uptrends. The mid-caps, small caps, and micro caps are still in uptrends. All stocks, emerging markets, and Bitcoin. Even though if we drop further below 60,000 with Bitcoin, we're likely to see a death cross there. And then our negative list, which is when the 50-day is below the 200-day simple moving average, not really long. It's still the euro to the dollar, and that should be USD, not SD. So another update, and this could switch back to an uptrend with the euro being favored. The Japanese yen to the US dollar, even though it's been bouncing back up, longer term, it's still in a downtrend. ARK is in a downtrend, and then the Pring World Bottom Index, World Bond Index. Okay, so thank you. I hope you found this helpful. I really hope you're having a great weekend, and I will talk to you in the next video.